Hey everyone, welcome to another episode of Invest Power series. LMI, friend or foe? That's what I want to talk about today. So as you all know, LMI stands for Lender Mortgage Insurance. It's basically an insurance that covers the lender as you go over 80% loan to value ratio, or what we call LVR. So as soon as you go over the 80% LVR, then LMI will be incurred. So is that a good thing or bad thing? And how can you actually turn that to your advantage? That's what we'll discuss a bit more today. So a quick recap on LMI. What is it? Basically, it's as you borrow over 80%, lenders treat those as a bit of a higher risk lending, and as such, they want to make sure that they purchase an insurance that covers themselves, so that in the case that if you do default or if you're not able to make repayments, then essentially they are covered. So lender mortgage insurance is not covering you, it's actually covering the bank, but the bank wants you to basically fork out money for it, okay? And that's because as you go over 80%, it's classified as high risk lending. And that's why anything over 80%, then essentially you will need to either pay the LMI using your cash, or most commonly have the LMI capitalized or added onto the loan, and you basically pay the total loan amount as part of your loan repayment. So with LMI, if you are purchasing an owner-occupier, then that's probably going to go against you. Whereas if you're using that to purchase an investment property, then it's not necessarily a bad thing. And let me explain why. So if you're using LMI to purchase your own home, that usually gets added up to the loan, which makes the loan amount higher. Now, because if you're buying your own home, that means the debt is not tax deductible. So therefore, you want to minimize your tax deductible or non-deductible tax in this scenario, okay? So that's why if you are buying your home, obviously if you can avoid LMI, that'd be my recommendation. But if you don't have enough deposit, and as we all know, it's very, very difficult to save up for deposit in the current environment, then sure, if you are going to have to buy a house with very low deposit, then yes, just we'll be able to factor in LMI into your loan, and you just need to make sure that you pay that down as part of your loan in the long term. Now, in an investment scenario, let's say for example, you want to be able to build out want to be able to buy 2 or 3 investment properties. And as we all know, you only need 2 resources to buy a property. You either need cash, equity, or you need the borrowing capacity. So in this case, if you are short of cash and deposit or equity, and you want to be able to still buy 2 to 3 investment properties, then what that means is you actually need to borrow more and use less of your cash so that you can go further. And by borrowing more, in other words, over 80% LVR, that means you'll incur LMI. But is that necessarily a bad thing? The LMI gets added onto the loan, and eventually you will, that will be treated as part of your tax deductible interest on that. So, it might not necessarily be a bad thing, because obviously you want to be able to maximize your tax deductible debt. So in this case, if it allows you to achieve the goal of, say, buying 3 investment properties whilst utilizing LMI, then to me, that's a little price to pay. So, in comparison to just say you can only buy 2 investment properties without the LMI, which one would you choose? So I think it's something for you to ponder on, okay? So LMI, not necessarily a bad thing. It depends on how you use it and what the purpose of the loan is. So there's our quick tip today, whether LMI is friend or foe. In summary, it depends on what sort of purchase you're making. Are you purchasing an owner-occupied property, or are you purchasing an investment? If you're purchasing an owner-occupied property, you want to minimize the amount of loan because it's not tax deductible, and therefore you should avoid LMI where you can. Whereas on the investment front, if you are short of cash or equity, to be able to purchase the number of properties that you need, then going over 80% and pay LMI get that added onto the loan may be an option. At the end of the day, that LMI get capitalized will also be tax deductible. Please seek accountant advice, because obviously I'm not qualified to be able to give you more accounting and tax advice on that. But in general, that's the concept about how you can utilize LMI to your favor instead of against you. So I hope you liked this video and hope you learned something new about LMI today. If you got any questions, feel free to comment below. Don't forget to like our video, subscribe to our channel. Again, if you got any questions, let me know by emailing to david@lempower.com.au, and I'll see you again in next week's Invest Power episode.